Well, good afternoon, everybody. We still got a few folks joining on here, but to stay on pace, let's get started. My name is Jamie Terrell, and I lead marketing communications here at Saltmarsh. We're very happy to have you all here with us. If you've joined our webinars in the past, welcome back. If this is your first with us, you're in luck. We've got lots of great information to go over together today. As you may have seen, new guidance has been issued since our last session, so we're going to address a few quick housekeeping items, and then we are going to get straight to what everyone is here for today. First, everyone has been muted. If you have questions during the presentation, feel free to share them with me in the chat. If we have some time for Q&A toward the end, we'll address some of those questions together. But I do want to mention that our time for questions may be limited just due to the information that we've got to cover, but we'll try our best. You're also welcome to share your questions with us via email. You can send those to ppp@saltmarshcpa.com, and someone from our team will follow up with you directly. That email is also provided for you in the chat. Today's session is being recorded, and you'll receive that recording tomorrow by email along with a copy of our slide deck. In that same correspondence, you'll see a link to complete a short survey. It should take less than a minute. We really do appreciate that feedback. Thank you to all of you who have taken a moment to take that survey for us. It's been extremely helpful. So with that, we do have the same members of our COVID recovery and response team here: Suzanne Cox, Glenn Scharf, and Andrew Kent, all shareholders here at Saltmarsh, and we are happy to have them here leading our discussion today. With that, I will go ahead and kick things over to Suzanne, shareholder in our audit and assurance practice, to get us started.
Hi, guys. So, like Jamie said, we're going to get through a lot of material today, so we're going to talk really fast. I'm just kidding. So, as you all are aware, there was some new new bill issued last Friday. And so we're going to walk through the effects of that, what's changed, what we don't know. Today's, I think, personally a little bit more interesting because we're going to talk a little bit about strategy and what is the best option for you to take based on some of the changes. And if we can get to it, we're going to answer some FAQs at the end. We have tried to weave into our presentation some FAQs that we've gotten either with your registration or that you emailed us. So we hope to be able to address those at some point. So HR 7010 stands for the new bill that was became into law on Friday. It is better known as the Payroll Protection Program Flexibility Act. Try to say that 5 times fast. I can hardly say it once. So the one thing to note here, and we'll get into it, is there are 2 sections that were modified. And so it's very important to understand that there are 2 different sections in this code. And I'm sure you all are glad, unlike the rest of us who spent the whole weekend reading it, that we're going to try to summarize it for you pretty quick. So one of the main changes to the loan was the loan maturity date. And so this is an important point to note, is that on the original language for the loan, it gave a maximum maturity. So the actual law gave a maximum, but SBA limited that term to 2 years. And that was in the rulemaking and not the actual loan. So I'm sure you all have heard that, on paraphernalia and whatnot, but that was an actual SBA rule, not an actual bill or law. So the revised language gives it a minimum maturity of 5 years and a maximum maturity of 10. And so the new law overrides that SBA rule that was put out. So this is, again, clarification on that there were 2 sections that were changed, the section 1102 and the next section is 1106. And so the main word you've heard in all of this entire process has been the covered period. And so there's 2 covered periods that are discussed in this code. And in section 1102, the covered period is actually talking about your eligibility to obtain this loan. And so the reason we think this is important to note is that part of the qualification to receive a PPP loan and be eligible for forgiveness is that you must have an employee count less than 500. And so the previous language had a covered period date of June 30th, and the revised language is December 31st. So it's very important, if you're on the larger size of business and you're on the larger size of loan size, you want to be careful that you do not exceed the 500 employee count. that could possibly affect your ability to be forgiven. And so if you're near that, if you're 480, 490, you cannot exceed that 500 count by the end of the year. So between now and the end of the year, if the application actually has, when you file for forgiveness, it has your employee number. And so if it's over 500, that could be a problem. So just keep that in mind if you're one of the larger companies.
And Suzanne, just on that same issue, you know, there are several other aspects that there are several other provisions in Section 1102, which deals with the Paycheck Protection Loan Program itself, not the forgiveness, that deal with borrower's eligibility. And so our point here being that when they extended that covered period from June 30th to 2020 out to December 31st of 2020, now you've got a much longer period. Any of those terms or conditions that gave rise to eligibility or that depend on that June 30th date, that's now been expanded to December 31st, 2020. So you got, you know, basically another half year that those provisions could apply to you for, you know, over the course of the loan or the program. So anyway, that's all.
Right. So one of the main changes I'm sure you guys have already heard about or read about, it's all over the headlines, is that the previous language, and so just to clarify, now we're talking about Section 1106, which is more to do with the actual forgiveness of the loan versus the eligibility of the loan. So in Section 1106, covered period here means that 8-week period. The one we've been talking about for weeks now is the date of your origination of your loan, you know, 8 weeks post that date has been your covered period. So now the revised language is that the covered period means from your date of your loan until 24 weeks or December 31st. So whichever one comes faster. And so this is a very important change here, and we're going to get into, you know, a lot more to do with that as we go on. But just note that this is probably the one you've heard the most is, you know, 8 weeks or 24 weeks. So the big question we get around that is, well, do I get to pick? I mean, do I have to, you know, go to 24 if I was good with 8, or, what happens? I mean, what do I do? So if you already have a PPP loan, yes, you can pick between the 8-week period or the 24-week period. And we're going to get into some more details, don't worry. But if you already have your loan, yes, this will be an option, and that's part of the strategy that we're going to talk about in a little bit. If you're just now applying for the loan, we were joking that, you know, you're a little late to the game, but, you know, frankly, you're right in time, because now that we all, you know, the regulations have changed 14 times, or, you know, you're just coming in at a perfect time. So you, however, though, will only be allowed to get the 24-week period. You do not have the option of the 8-week period if you don't have a loan at this point. So Andrew, I'm going to pop it over to you, and we're going to start talking about our situation from our second webinar, Do Right Services. We're going to continue on with a few of our examples there.
Sure. So thanks, Suzanne, and good afternoon, everybody. Appreciate everyone joining us out there in the internet world for round 3. So if you were at our last webinar, you might have remembered we created a little hypothetical company, Do Right Services. And this slide just kind of goes over some of the basics behind the premise. Average payroll of $100,000 a month, got some employees at, you know, different salary levels, applied for and received a PPP loan of $250,000. The loan was funded on May 15th. And so their original covered period under the act as it existed was from 5/15 to 7/9, 8 weeks or 56 days. Under the revised provisions of the Forgiveness Act, the new covered period would be from 5/15 to October 29th, 10/29 of 20. So 24 weeks or 168 days. And we're going to look a little bit about how that might impact our good friend Dudley. So Suzanne, the next slide. So once again, if you were in our last webinar, you remember that when we went through the calculations for Mr. Do Right, he was total came up to $190,930.95 in forgivable expenses. And so this was an example of how, depending on where your payroll actually shook out, depending on what your business interests, business rent or lease and utility payments were, it was, you know, very possible under the 8-week period for a borrower to have a significant portion of their loan that would not qualify for forgiveness. In the do right example, we had 59,069 that would not be forgiven. And so the discussion prior to this change was often with clients about, well, can I pay hazard pay bonuses? Can I, what are the other avenues available to me to use up that, to assist my people obtain maximum forgiveness? But if we go to the next slide now, and we look at the impact of a 24-week period, what you see is that over a 24-week period, and assuming the same payroll levels, do rights, total payroll and total forgivable expenses are now $566,540.39. So that's well in excess of the $250,000 loan amount, and nothing would have to be repaid. So on its face, it looks like the 24-week period has some advantages because it allows the borrower to obtain full forgiveness. Suzanne, you want to go to the next slide? So the choice seems obvious. If you're due right, the 8-week period leaves you repaying $59,069.05. The 24-week period, you have nothing to repay. So it seems obvious that the 24-week period is better. However, we feel there are some other factors to consider, specifically some of the forgiveness limitation test and some of the other items. And so to make an informed decision, you really have to step back and look at the other changes that are in the PPPFA. So Suzanne? All right. I think this is still me. So changes to limitations on forgiveness. So if you recall, you're probably aware, or if you've been to one of our other webinars, you would recall that there are limitations on forgiveness. So in the laws originally drafted, you have a limitation if you reduced salaries or wages by more than 25%, and those salaries or wages were not restored by June 30th. Or if there was a reduction in full-time equivalent employees and those FTEs were not restored by June 30th, 2020. A couple quick points there. When we talk about a reduction in salaries or wages, we're talking about a reduction at the rate of pay, not the amount paid over the period. So in other words, if you have somebody making $100,000 a year, they were salaried, you would have had to drop their compensation to $75,000 or less. If you had somebody making, say, $20 an hour, it would have to be dropped to $15 an hour or less. So that salary and wage reduction is not a reduction on the gross amount paid, it's on the rate of pay. So the new PPPFA modifies 1106 by doing a couple things. It replaces June 30 with December 31st, 2020, and it adds a couple new provisions, an exemption based on employee availability, and a requirement that at least 60% of the loan principal must be used on payroll. And so we're going to touch on all of those changes here in the next slide. So the impact of the salary hourly wage test. As a practical matter, we're not seeing a lot of our clients being impacted by this because for the most part, what we're seeing is clients cut hours, not actual rates of pay. But if you did cut rates of pay, a couple things to keep in mind here. The impact to this test is calculated separately for each employee. You only have an impact if you cut salaries or reduce wages by more than 25%. So if it's less than if the cut was less than 25%, there's no impact. So in our previous example, you got a guy making $100,000 a year, you cut them to $80,000 a year, this test doesn't apply. If you cut them to $70,000 a year, then the test does kick in. There is a safe harbor provision, and that safe harbor provision requires that the salaries or wages are restored to their prior levels on or before what is now 12/31/2020. And if your safe harbor is not met, the calculation is based on reductions in excess of 25% during the covered period. That is a little key here, as we're going to see in the next slide. So, Suzanne?
Yeah, one thing to comment there, and this was something I got a little confused on when I was reading through it, is if your covered period ends before 12/31 and you meet you know, the FTE test and you haven't reduced salaries and so forth, you don't have to wait until 12/31 in order to file. And we'll get to that in a little bit, but just understand that safe harbor is there in case you have not been able to restore your original numbers by the end of your period. So if you choose the 24-week period and you say you end in September, then at September, if you're fine, if your FTEs are still good and your salary is still stable, you can still file at the end of that 24-week period. You don't have to wait until the end of the year. So if you need that time, though, that extra time to get back up to full capacity, then you get, you know, till the end of December.
Great point, Suzanne. Thank you. So how does this impact the calculation? So let's just take a quick example. Let's say Do Right has a salaried employee who made $100,000 a year pre-COVID. Post-COVID, their compensation is reduced to a rate of $60,000 a year, which is a 40% reduction. They don't meet the safe harbor. Let's assume they don't meet the safe harbor and that the comp is not restored by December 31st, 2020 for whatever reason, economic conditions, whatever other factors may be out there. So under the original rule, the calculation was it's the reduction in excess of 75% times the number of weeks divided by 52. So under the old rule, the reduction in excess of 75%, which is 25%, I mean, which is $15,000. It's $15,000 times 8 divided by 52 is 2307. Under the new rule, it's 15,000 times 24 divided by 52. So it's $6,900. It's basically 3 times. It's triple the reduction. So something to keep in mind, if you have a reduction in compensation in excess of 25% and you are unable to restore that comp by on or before December 31st of 2020, the potential hit that this can have because of the additional weeks is significant. It triples the impact of this reduction. And because you're not getting any additional principal with the act, you're not getting any new money. They're not loaning you additional money to make up for the fact that the period is, 3 times longer. This could have a real impact on your ultimate forgiveness.
Yeah, just one more comment there also, that you can reduce your wages up to 25% with no effect on the forgiveness reduction. So if you reduce wages by 10%, that would be okay. It's just wages that were reduced in excess of 25.
Yeah, and the other thing to note is, in the previous slide, that Andrew was mentioning is by 12/31 or the end of the safe harbor or end of the period. So you can do it literally the day before or the day up. On 12/31, you can restore their wages. You pay them for that, if in their paycheck that is paid their full wages, then that counts. So there's nothing, that says it has to be, for a certain period of time or anything like that. We believe that that's the date. If you do it by then you're fine.
Right.
Good point.
Yeah. All right. So the other limitation on forgiveness that existed in the original forgiveness statute was the FTE reduction quotient. So we're not going to go through the mechanism again of how the reduction quotient works, but just big picture, the safe harbor test for FTE reductions is now on or before December 31st, 2020, instead of June 30th, 2020. If you recall, the FTE reduction quotient takes the average FTEs for your covered period or your alternate payroll period and divides them by the average FTEs for a chosen reference period. All the chosen reference periods and everything else have stayed the same. The only difference here is that you're measuring your average FTEs over a much longer period, 24 weeks versus 8 weeks, and the safe harbor deadline is now December 31st, on or before December 31st, 2020. This quotient does apply to the entire forgiveness amount. So basically you take your FTEs during your covered period and you divide it by your pre-covered period FTEs. That's oversimplifying it a little bit, but if it's 1 or more, then there's no adjustment. If that quotient is less than 1, then there is a reduction. There are exemptions for rejected offers to rehire, for-cause terminations, and voluntary reductions. All of those stay in place. So Suzanne, you want to go to the next slide and we'll look at how this might impact a borrower. So,
Did I skip a slide by accident?
nope,
Bye.
you're good.
I'm good. Okay. My next slide thing is not working right now, so I was hoping I didn't.
So we're calling this the potential FTE trap, and I'm just going to go through a quick explanation to kind of so everybody understands how this might work. Because a lot of people step back and said, "Oh, this is great. I've got 24 weeks now. I can stretch my PPP loan proceeds out. That will help me." There is a trap here, and so let's just super simple example. Let's assume a borrower got a PPP loan of $30,000, and they have 3 full-time employees, all of whom make $1,000 a week or $52,000 a year. Under the 8-week cover period, 3 employees times 8 weeks times $1,000, you'd have $24,000 in forgivable payroll. And your average FTE during that covered period would be 3. Same as before you got the loan, same as pre-COVID. So the FTE reduction quotient wouldn't apply. You don't even have to worry about the safe harbor because you didn't have a reduction in FTEs. You're good. You've still got to deal with the $6,000 in additional cost to seek forgiveness for, but you've maximized your payroll, or at least you've gotten your full. You're able to get full forgiveness for that $24,000 in payroll. Under a 24-week period, if the borrower says, "Hey, I want to stretch my money out now," and so they lay one person off and cut the remaining 2 down to 50% time in order to stretch the funds. Well, 2 employees for 24 weeks at $500 a week gets you to the same $24,000 in forgivable payroll. So on its surface, it might look like you're in the same place, but the difference is now you've averaged just 1 FTE over your covered period because you had 2 people working half-time instead of 3 people working full-time. And so unless you can meet the safe harbor provision and return to 3 FTEs by December 31st, your forgiveness is going to be reduced by 2/3 in that example. So that's an example where, really the extension of the covered period doesn't help you, it doesn't give you the flexibility necessary to lay people off or cut back on payroll and still get that entire payroll forgiven unless you can somehow meet the FTE safe harbor by December 31st. And while, I'll just point out that while we say, yes, you can rehire people on or before December 31st, keep in mind that that's 6 months from now. We don't know what the market conditions are going to look like. We don't know what the economic environment's going to look like. And there's a cost if you have to go out and hire a bunch of new people in order to get your FTEs back up. Certainly there's a cost if you're just doing it to try to get to your FTE number so you get forgiveness. So just something we want to point out, a potential pitfall in.
Yeah, Andrew, I'd like to point out also is that, a lot of people have been asking about this $100,000 limitation as well. And before, with the 8-week period, the prorated portion was $15,385.
Right.
And so now, the prorated portion over a 24-week period is like $46,000. And so even though that sounds great that you can utilize your funds, you still fall back into this trap. Remember, the point is that, that you have to remember that the loan was only calculated based on that 2.5 months. And so in theory, if you pay someone more than that, 2.5 months, which would be 10 weeks, then you're potentially reducing your FTE count by just paying them more than that, even if they're still working. And so that's something to consider, is that who you're paying and for how long when it comes to this 24-week period.
Absolutely. Yeah, no, great point, Glenn. All right, Suzanne, next slide.
This one's still you, Andrew.
Okay, so one of the new provisions in the PPPFA is the employee availability exemption. So the FTE reduction quotient will not apply if a borrower can document that they were unable to rehire individuals who are employees on February 15th, 2020, and they were unable to hire similarly qualified employees for unfilled positions on or before December 31st, 2020. So if you've got people that were employees in February and you can't get them back, and you're unable to fill their positions because you can't find similarly qualified people, you can document that and you can possibly obtain an exemption to the FTE reduction quotient. So that would be another good example where, you know, you can't hire people back and you can't replace them, so your FTEs are down. This gives you a safety valve for that situation. And then the second part of this employee availability provision is if you can document that you are unable to return to pre-February 15th levels of business activity due to compliance with requirements established or guidance issued by the DHHS, CDC, or OSHA between March 1, 2020 and December 31st, 2020 that are related to COVID-19. And so these are going to be things like social distancing, sanitation, customer safety, or worker safety requirements. Now, this sounds like it may be somewhat of a get out of jail free card, especially for those who are in hospitality industries, say restaurants or bars where you were shut down for some period of time. We're going to point out here that we're still, you know, this is brand new. We don't have guidance on this yet. And specifically, we don't have any guidance on how you're going to document this, what type of documentation you have to prove, and, you know, whether or not you have to document, was it just for a portion of that March 1 through December 31st period, or whether you have to document that you were shut down for the whole period. You know, for example, a lot of restaurants are in Florida here are reopening. And so, you know, at what point does that restriction end? And once again, is it good enough that it was just in effect for some period of that time frame, or does it have to be in effect for the entire period of that time frame? We just don't know that yet.
Yeah, a lot of questions around that piece because of all the things Andrew said. So we right now don't know about that. We have not gotten further guidance, and so this could be a big piece of it for consideration of forgiveness if, in fact, you know, you could somehow prove during this period that you had a decreased, you know, level in revenue or something similar. So again, we don't know a lot here and didn't want to assume without further guidance.
Yeah, and I would say as far as the documentation goes, especially for the first one, that, you know, you really want to have and make sure that you have the documentation. So for example, you know, if you're doing similarly qualified employees, all right, so if I need, you know, in my business, we're CPA. So if I need a CPA, if we had to lay one off, which we didn't, but if I needed one and I put an ad in the paper or I did, you know, online advertising and things like that, you want to make sure that you've documented all the things that you've done, not only to get another qualified person, but also, you know, if you have to save resumes. Let's say I got resumes of just non-degreed accountants that were, you know, in an accounting department that weren't sufficient to what I needed. You need to make sure that you're documenting that the people that were applying for the job were not qualified for the job that you posted, and if you're not hiring them. And so those are the things that are going to be really in the documentation to help you prove that these similarly qualified employees were not obtainable.
Yep.
Yeah, that's a good point. The guidance even says that you need to show your emails trying to hire people, you know, or declines of employment. If people left, you know, either quit, they weren't comfortable coming to work, you've got to show that you notified the state for unemployment reasons. And so we talked about that a lot in our second webinar, but, you know, definitely document all of these activities so that when you go to your lender to request forgiveness, they'll be able to track and, you know, outline what you've done to try to rehire. So Glenn, we're going to pass it over to you now to talk about some of the limitations.
All right, great. Thanks, Suzanne. So now we're talking about, you know, limitation of forgiveness and what that really means and what, you know, what are some of the numbers here. So before we had in the law, there was no designation for how much you had to spend on payroll costs. That was the SBA on the rulemaking process that came up with that 75-25 split. Certainly, you know, some companies had problems meeting that requirement if they had, you know, for example, high costs in other areas like rent and things like that, and lower costs in payroll. So, you know, they came back, and part of this new law is this is statutory now, that it has to be 60% of the loan proceeds has to be on payroll costs. Now, and then up to 40% on those allowable non-payroll costs. So let's be clear here is that 60% is a floor meaning that that's the minimum. You can spend 100% on the payroll costs if you want to. That's okay. Remember, you still have to qualify for the FTE requirements, the wage reduction requirements. So you still have to meet those other requirements. So they're probably, especially in this 24-week period, like we said before, is that more likely than not that you're going to have more of these other expenses come in to meet the requirements and getting that FTE, and those other qualifications right. So once again, just minimum, the floor, 60% is the floor. So
yeah,
all right.
just to add to that, we get the question a lot is, well, what if I can't meet this, 60%, can I get partial forgiveness? So that is allowable. So if you, for whatever reason, only hit 50%, you can get partial forgiveness. You're just not guaranteed full forgiveness. So again, that's just, something to note there.
Suzanne, I'll point out too that, while that provision has gotten a lot of press and a lot of discussion, so much so that the House felt it necessary to address it in the in the new bill. As a practical matter, if you're taking advantage of the 24-week period, it's probably a non-issue for you. So just want to point that out, meaning that you'll most likely have payroll in excess of 60% of your loan principal amount if you're taking advantage of the full 24-week period.
Right. I mean, you would essentially have to have a third of your payroll or less that you had, in 2019 to not be able to use the entire payroll amount, that we're talking about. So that would be a 66% reduction in your labor costs. Hopefully, no one's had to do that. But the other thing is that most likely, in the 24-week period, we're not going to see any issues about spending all the money. We're going to see issues of whether it's qualified spending and whether there's going to be reductions because of FTE or things like that, because they have to be stretched out and can't open and things like that. And so that documentation, once again, is going to be very critical when you apply for these for the forgiveness and you're allocating, where your payroll costs, FTE numbers are, et cetera. So I think it's very important to note. All right, let's go on to the next slide, the filing date. Okay, this is a big question that we've gotten is, when do I have to file? You must file for forgiveness within 10 months after the last day of your covered period. So, once again, if your covered period ends June 10th of 2020, you don't have to file for forgiveness until April 10th of 2021. But what happens if you don't file? And that means then that the principal, the interest, and all the fees will be due beginning on that day, that 10 months. So in our case, April 10th, 2021, you're going to have to start paying back that money. So there's not a rush to file for forgiveness, but don't be a procrastinator. Let's get through the process and get it done with. So because you want to be able to also be aware of, okay, let's say you spent all your money, but hey, I got reduced, now you've got to be able to plan for that reduction and what you're going to have to pay back. So obviously right now, you can't even file. The application for forgiveness that came out will probably be redone. And so, the clock is not, critical right now in that sense. Everybody, we've got some early people that are just coming due now. And so are asking about, oh, I have to file right away. But no, we don't. We've got to make sure the banks catch up first and get the loan applications and their processes in place, et cetera. So
yeah, just to add on, that be in communication with your lender, if they're setting up a portal or if they've got specific requirements in addition to the SBA or the law's requirements. Don't forget that forgiveness determination is ultimately on them, and then they send it to the SBA for further review. And so they may have some criteria that they want you to meet in order for them to make that decision. So, stay in communication with your lender. As Glenn mentioned, the application will change, obviously, likely very, very soon. We don't have that application yet, but hopefully it'll come out soon. So Just again, make sure you're communicating with your lender. Also near the end, if you decide, you know, hey, I really don't want to file for forgiveness, I'm just going to ride this out, pay the loan off, you know, start communicating with them your plan. If you don't intend to file for forgiveness, you know, let them know, because they've got to redo their loan documents and so forth to now convert this to, you know, the term loan that we discussed the terms about earlier. So just, you know, keep in communication with your lender during this time. It's really important to them.
Yeah, and once again, you know, the point about, you know, whether I want to make loan forgiveness or not, you know, it could be a set of circumstances, and don't confuse that with you weren't eligible to get a loan in the first place. If you weren't eligible to get a loan in the first place and you got one, then you need to return that right away, as opposed to, you know, I didn't spend the money correctly and then now my forgiveness is reduced. So there is a difference there. So the extension of the deferral period. So when do I need to start making payments? So the previous language was, you know, that it was not less than 6 months. So you didn't have to pay principal, interest, fees, etc. Could be a minimum of 6 months, but up to a year. So we revised that language a little bit. So we've got this deferral, including principal, interest, payments, fees, the date which the amount of forgiveness is remitted to the lender. And that means from the SBA, not your submittance, you know, your remittance to the lender. It's the SBA's remittance to the lender. So essentially, you know, once you file your application, the lender has 60 days to go through that application and make a decision on forgiveness. Then they pass it on to the SBA. They have 90 days to review it, etc., and then make their payment for your forgiveness amount to the bank. So just kind of going through our little Dudley Do-Right example here, he chooses the 8-week period. So July 9th, ending July 9th, applies for forgiveness on July 30th. The lender will approve, the lender approves 8/31 and the SBA approves 10/31 and remits the payment. So that's when his payments are going to start. If he's got something that was not forgiven, it would start on October 31st of 2020. So just, you know, obviously these dates are not, this would be the latest that you can go. You know, so if you wait 10 months to apply for your forgiveness, you know, so let's say in this instance, his 8-week period ends 7/9. Well, what's 10 months? 5/9 of 21 of next year. You could wait that long and then you get another 60 days for this, you know, for your lender to do it, and then another 90 days. So we're talking 15 months out is possible. I don't think that's very likely in the sense that, you know, I don't think the lenders are going to take 60 days to review applications. They're going to be turning over as fast as they can because they want to get these loans and get paid for them, as the interest rate is not really that great for them. So, you know, who knows how long the SBA will take? We've seen them take a long time for guidance here. So who knows and how quickly they'll be able to do that, and what kind of turnaround that they're going to have. We just don't know.
And if you're one of those 15-month people, I'm sure there's a procrastinator support group that you can join, because there will probably be a lot of people in it with you that are doing the same. So
right. Yes. Yeah. After this, we'll be starting our webinars on PPP support group support. So, you know, everyone can come and say, hi, I'm a PPP-aholic.
It's been 14 months and I need to file.
So anyway, all right. So the final piece of kind of one of the things that we wanted to cover today is, you know, before we get into some strategy pieces, is this delay of employer payroll taxes. This was a really big contention from before, in that, you know, the previous language said that, you know, if you had 50% of your employer payroll taxes, so were deferred until 12/31 of 2021, and then you could pay 50% at 12/31/2022. So, but you couldn't defer any of your taxes after you got forgiven for the loan. And so it was kind of like one of those things that we were, you know, paying taxes and not being able to defer into these periods. And that was really a true payroll cost that we didn't see. And so we've revised that language now. And so regardless of whether you've gotten a PPP loan or not, your portion of payroll taxes, the employer side of payroll taxes, which is 7.6, no, the 6.2%, is deferred, and 50% would be due. So you can defer all the way through at the end of this year. And so then your 50% will be due, you know, so if you defer $25,000 of taxes between now and the end of the year, you know, 12,500 will be due in a year from December, and then the other 50% will be due 12/31/2022. So everyone kind of got some relief on that. So if you want to, you know, my suggestion is, if you know, from that standpoint, if you're operating and you're able to pay those taxes and it's not, you know, egregious to you, get them out of the way. Just go ahead and do it. You know, that way you won't have to worry about these things. I mean, 2 years is a long way away, a year and a half to try and remember these things and filing and whatnot. You know, this is when we get into the strategy piece of how long do we want to deal with this in our lives versus, you know, getting it over with and going forth. So, so that, I think, is a good segue to our next slide, which is some of our strategies, things that we're going to talk about. And Suzanne, I'm going to turn it back over to you for this.
Thanks, Glenn. So the big question, obviously, here, we're getting a ton of calls this week from our clients. You know, my loan is coming due, or my 8 weeks is coming due this week. I'm just shy of, you know, my amount of my loan. So what should I do? Should I wait? You know, should I go the 24 weeks, or should I just go ahead and file? So there's a couple of questions that you need to, you know, ask yourself. How close are you to your full forgiveness? Are you, you know, $10,000 off, or are you $400,000 off? You know, because we're going to talk about balancing, you know, risk and reward in a minute. And so if you're real close to it, that, you know, that matters, or if you're real far away. The next main thing, probably the most important, is, you know, can you anticipate or project out what your FTE count will be at the end of your 24-week period? So, you know, none of us know what's going on right now. COVID cases are up. We don't know if they're going to put us back in lockdown. You know, we're hypothesizing about a lot of economic activity right now. Some businesses are coming back and starting to see recovery, and then others that maybe didn't have the immediate slowdown, like say restaurants, are starting to feel a bit of their crunch, and so they're starting to slow down. And so, you know, if you're an owner of a business and you're thinking, you know, if things slow even more, I may have to let someone go, or I may have to, you know, make salary reductions. And so, you know, the next biggest question is, do I potentially foresee a reduction in salary and or FTE count if you're now extending that 8-week period out to 24? So you could be doing great right now at your 8 week. You've got all your employees, you haven't made salary cuts. You know, if you're only $10,000 off, you know, maybe you go ahead and file, because the unknowns, you know, outweigh that risk of the $10,000. So also, what industry are you in? Are you, you know, subject to any regulations? Are you a restaurant? Are you in construction? Do you have, you know, requirements that you may have to meet, social distancing requirements? If you're a movie theater, you know, things like that that would really potentially cause, you know, a decrease in one of those things we just talked about. And then some other little sneaky areas that maybe you haven't considered that you probably should is, you know, Glenn just mentioned how this could potentially be 15 months out before you get a final determination. You know, if you're a procrastinator and you wait your 10 months, and then your bank, you know, they have their time and SBA has their time, you know, we're into 2021. And so at 2020, this is a legitimate loan. This is an obligation that's outstanding. And so if you've got debt covenants that, you know, require you to stay within a certain debt to equity threshold, or, you know, anything that might affect this increase in debt, I mean, depending on how big your loan is, this could really have an adverse effect on some of your loan covenants of existing, you know, lines of credits or loans. So you want to keep that in mind. Also, if you have any other, you know, obligations, you know, surety, if you're a contractor, and this might be a potential surety issue to add debt to your balance sheet. If you're a franchisor and have to meet certain ratios in order to stay in your franchise and, you know, meet your franchise agreement. If you have other agreements, if you're a not-for-profit and your grantors require you to maintain a certain amount of debt, you know, these are all things you need to consider, because that debt might be sitting there at the end of 2020. And so you need to again, consider if that will negatively affect any of these other areas, and, you know, not just have a myopic view of, oh, you know, I want that $10,000 forgiven. You know, you've got to think more broadly in a larger spectrum if this affects other parts of your business.
Yeah, Suzanne, let me bring up another thing here, is that I think it also depends on, you know, where you are in the process of your 8 weeks. And so, you know, we encouraged, if you came to our first webinar, you know, we were obviously under much different rules. And the whole point of the original Paycheck Protection Program was to make sure that employees were still being paid and not having to file for unemployment. You know, and so we were encouraging people to pay people even though they weren't working, because that is the only way you were going to utilize these funds in the 8-week period. Well, now let's say you're right now sitting in week 7 and you've utilized all those funds and paying people that weren't necessarily working. Well, now if you choose a 24-week period, you may not, and you have to scale back on your employees, you know, that FTE count's going to go way down. Whereas right now, even though they weren't working, you were paying them and they count as an FTE. And so the 8-week period might come into play a little bit better than a 24-week period, and trying to drag that out and then getting that cut that's 3 times the amount, you know, if you were to drag it out in that 24-week period. So you really have to, you know, really understand where you're at in the cycle of things, and what you did during this cycle that you've had the money already under different rules.
Yeah. Suzanne, and the only thing I just to add, and kind of just to put a fine point on it, is, you know, ultimately your loan principal is based on roughly 10 weeks of pay. And, you know, when they extended the covered period to 24 weeks, they extended the covered period without increasing the loan principal amount. So they didn't give you any more money to continue to pay people over that 24 weeks period. They just gave you more time to use it. And so, as Glenn just very well pointed out, depending on where you are in that process, if you've already used substantially all of your money, you know, you know, you're gonna commit to another, you know, essentially what, you know, 14 weeks of monitoring to pick up, you know, 2 more weeks of pay or something.
Yeah, just to add to that, I know this has been a common question as well, is, you know, do you have to wait out that 24 weeks, or when you hit your number, can you file? You do have to wait out that 24 weeks. So if you get to week 12, I know most of my clients are within just a week or 2, and you can't, though. You can't hit week 12, you hit your number and you file. You have to wait that full 24 weeks if you choose that option. So pros and cons on each approach, right? So apply after 8 weeks. One of the pros, you know, get it over with. You know, regulations are what they are. You don't want to deal with it anymore. You're tired of our webinars. You don't want 6 more weeks of you know, salt marsh PPP webinars. You just want to get it done. Just a little plug there too. We are assisting with loan application as well. So if you just, you know, just want to wash your hands of it, you know, send it to us. We'll just get this thing over with it. So another pro, you know, the shorter FTE period, like I just talked about, it's known. You know, you have the same employees right now. You know, you haven't given them a pay cut. You know, these are all pros here. Con is, you know, if you're that person with a $400,000 deficit right now, maybe that's a big con. You know, that's much larger than the pros, and it outweighs the risk of waiting. So that's a consideration you'll have to make internally. That is a con, though, of the 8 weeks. If maybe you're going to lose a little bit of forgiveness, that, you know, that could be a downside. Now, the pro and con of the regulatory risk, it could be that they decide, hey, you know what, loans under 350, you know, we don't even need to see an application anymore. That may be coming down the pike. Now, you know, we don't know that. So, you know, take that, understand that I'm not saying that's happening, but that, you know, that may happen, and regulation may change. So there could be the con of, hey, you go ahead and you file this application, and then, you know, the law changes that maybe would have been more favorable to wait. We don't know, though. We don't know if regulations will change again, and if they will be more favorable. They could be more unfavorable. So the regulations right now may suit you just fine. and that could be seen as a pro. So let's say you
Also
decide
that
to
SBA, the SBA rulemaking, that like we saw, nothing in the law for that 75-25 split. That was their rule. Okay. So we haven't gotten any guidance from the SBA at all. And so we don't know what kind of rules they're going to come up with as well. And so that's
as a
part of
result
that
of
risk
this.
too.
So some pros, obviously waiting till the end of the 24 weeks. The pro here is that you get 6 more weeks of SCG PPP webinars. So we're here every other week for you. One of the other pros though is you'll probably burn through the money, right? You've got 24 more weeks. There's a lot of interest and a lot of utilities and a lot of payroll that you can cover in the next 24 weeks. So that is a pro, that you will most likely utilize all of that money. Again, don't confuse utilization with forgiveness. So you may utilize all of those funds, but again, keep in mind that you may not be eligible to be forgiven for all of it. For our con number 1 is, say your FTE drops. This is an unknown. So, business starts to go downhill. You've got to make some changes for cash flow reasons. Like Andrew has mentioned earlier, is this extension of time did not extend your funds. You didn't get any more money for this extension here. So you still have to run your business, and you still have cash flow issues, and you've still got to manage those cash flow issues. So there could be an unknown of, what's going to happen, and do I think that I may cut back on employees or have to make salary cuts. And so that's obviously internal. You'll have to do some projections and, get with your management teams and figure out if you think those things are likely, and how likely. Do they outweigh that, amount that we can't possibly utilize over in the 8 weeks? We talked about the bank covenants. That could be a con if this could potentially roll into 2021. That could impact some things. Andrew talked about it earlier, is the salary and wage reduction is now not only over 8 weeks, but it's 3 times that. So if you do foresee potentially making any salary and wage reductions, just consider that they're going to be threefold. And again, we talked about the regulatory risk, so I'm not going to repeat that, but that can be a pro and con. We just don't know what's next. So we're going to talk about, or Andrew's going to talk about, what did Dudley Do Right do? What did they decide to do?
So, right. So just to kind of cap off this discussion, back to our little hypothetical here, in Dudley's situation, it's only going to take a little more than 1 additional payroll cycle to cover the gap to full forgiveness. And so, this means that Dudley will be subject to nearly 3 months of covered period in which it must maintain FTEs and compensation before it can apply for forgiveness. And as we've already discussed, there's a risk there because you get out, the money, use up the money in the first couple, by week 10 or 11, the money's gone. You've now got, another 13 or 14 weeks that your business needs to keep trucking along so you can meet those FTE requirements. And if something intervenes, if there's another shutdown or a lockdown or a situation out of your control, you could go from thinking you were having full forgiveness to now having forgiveness that's substantially reduced because of the FTE requirements. Now, of course, we have these new exemptions. We don't fully know how those are going to play out, how the rules are going to define what the reporting and documentation requirements are for those. So just pointing out that there's a risk. Still, in Dudley's case, if he's reasonably confident, that relatively large gap in forgiveness, that $59,000 between the 8 and 24 week period, does make the 24-week period, pretty appealing if he's confident in his economic outlook and if he's confident in what he thinks his FTEs would be. If that number were smaller, if it were $5,900 instead of $59,000, I think for the reasons we've already discussed, it becomes a no-brainer for Dudley. You choose the 8-week period, you go ahead and file for forgiveness, and you move on. So Suzanne, our next slide.
We actually have been making really good time. So we do have a few minutes to pop through some of our FAQs. So these have come not only from when people registered, they put in questions, and also now Jamie has been, sending us some as well. So we're just going to cover some of the hot topics here. Glenn, if you want to take this one.
Yeah, so can you replace an employee with a different employee, and do you have to pay them the same? Yes, you can replace them with a different employee, and no, you do not have to pay them the same. Should be fine.
All right. What does
I
the
think-
process look like?
Yeah, I think we've pretty much beaten this one to death about the 10 months and the 60 and 90 days. So let's move on to the next.
Yep, sure, go ahead. Do the
Yeah.
additional costs of giving employees remote access or PPE costs count for forgiveness?
Yeah, no, these costs are not eligible for forgiveness. They're not considered a utility. Remember, the includable costs are payroll, interest on outstanding debt, utility costs, and rent, and all must be in service by February 15th of 2020. So if you've got to incur additional expenses and things like that, those are not going to be included.
All right. Are management fees or payroll fees part of the payroll costs?
Yeah, no, I've had this question quite a bit. They're not considered in the payroll costs. So even, if you are getting temporary employees, things like that, I had somebody ask me, I had a marketing person and I replaced them with a marketing firm. Does that count? Nope, it's not payroll. Now you got an independent contractor. So payroll costs are very limited to these items on here. Workers' compensation also not included in payroll costs.
Also not included are life insurance premiums. We didn't put that on the slide, but that is another thing not included in payroll. What about the cost of shipping? If you're shipping your goods, is that included?
Well, we still don't have clear definition of this, but we don't think it counts. You got to have an agreement in place before February 15th. We've seen no guidance whatsoever on transportation costs. Except if you're a sole proprietor. We've seen other things, for example, leases on automobiles, those are deductible and included in this. But once again, the ultimate decision is going to fall on the lender unless further guidance is issued by the SBA. So we're hoping we get more guidance on transportation, but.
I think the $1 million question here, though, is are fuel costs included?
Yeah, no, I don't think so. There's no contract in place before the February 15th deadline. So putting gas in your car, in your company car, we don't think is included.
All right. What about vehicle loan payments?
So vehicle loan payments. So the principal amount of any loan payment is not allowed. So remember, it's just the interest on obligations existing prior to February 15th. So if you went out and you bought a new vehicle, last week, not includable. So only obligations included, and yes, the interest expense, we believe, on vehicles, machinery, anything that is secured by the obligation, is the interest is includable.
All right, we've got time for one more before we wrap it up. What about employees making over 100? Does that mean you have to reduce their pay, or do you just have to track that?
Yeah, that's a great question. When computing the eligible payroll costs, you must deduct the amounts that are greater than the 100,000 for each employee. So, if we talked about that 15,385 amount is that 8-week period for $100,000. So if somebody's making $150,000, and you may pay them that, but you take that prorated amount that's less than the 100. So a third of whatever their paycheck is, if you're paying them 150, a third of that would not be included in that payroll calculation. So it's not that you need to reduce the employee's actual pay, you just reduce it based on the amount that's eligible for the loan forgiveness.
Awesome. I know I've been getting that question a lot. All right. Well, oh, wait, one more. What about officers' comp? Is that included in payroll?
Yes. So officers' comp can be included, once again, up to the $100,000 per officer. We got to be careful here for an S Corp owner, though. There's a specific rule that basically says, that you have to take your prorated portion of 8/52 of your 2019 salary. Now that's 15,385, so for that 8-week period. So if you were only paying yourself $20,000 last year as an S Corp owner because you wanted to take bigger distributions, well, then that's all that's what you're limited to. You cannot raise your income. That's the only person who cannot raise their income, get a bonus, do anything like that. The S Corp owners are strictly, limited. Now, is that number now 2450 seconds? We haven't seen that. But once again, if you do that, the 2450 seconds, you're going to have FTE problems. So you've got to be careful when you do these, these highly paid people and how you're counting them and making sure that the FTEs are the most important thing.
Yep. All right, well, we're gonna pass it back to Jamie here to close us up. We're right at 1 hour. So Jamie.
Yes, so just for those of you who have shared questions, we've received several questions throughout the webinar. Some of them have been addressed, but for those of you who are still waiting your answers, just bear with us. We're gonna address those questions with you offline after today's presentation. Just a reminder as we're closing up, thank you all again for joining us. And remember that we are here to help you navigate this process. And that's exactly what we want to do. So if it's as simple as answering your questions, helping you kind of along the way, all the way to, as Suzanne mentioned, preparing these applications. We understand some people just don't want to mess with that even, and that's just fine. So please reach out to us if we can be of assistance to you in this process. You can email ppp@saltmarshcpa.com. That's the same email you can direct those questions to. If you have any following the webinar that you want to share, please send them our way. We're happy to help you out, and hope you'll join us again. We'll keep you all updated on our next session. We, as you know, will continue to hold these, and we're happy to have you with us this afternoon. So enjoy the rest of your day. Please let us know how we can help you, and we look forward to having you with us again soon.
Thank you, everyone.
Thank you.
And thank you to our great speakers who kept us on time. You guys are good.
Yeah.
We talk fast.
Thank
We'll
you.
invite you back. Thanks, everyone. Have a great one.
Thanks.